Hi, my name is Dean Mead, and I am a partner and government and public sector subline leader with Carr, and Ingram, or CRI. Every item you see in a government's financial statements has a purpose. That is true of deferrals as well, though you may not be clear about what that purpose is. Now that we have talked about what deferrals are and where they came from, let's dive into why it is important that governments report them. In general, deferrals serve two major purposes. They help to put revenues and expenses in the right years and to make sure revenues and expenses are reported in the right amounts. Why is it important that revenues and expenses are reported in the right years? Well, in addition to the general need to report finances accurately, putting revenues and expenses in the years they belong to helps to achieve one of the key objectives of government financial statements, helping the reader to figure out if a government is living within its means from year to year. In other words, balancing its checkbook. Governments may not need to run a profit, but they do need to raise enough money each year to pay their bills. The alternative is draining their savings, which may leave them vulnerable in an emergency, or pushing costs off to the future, which generally increases those costs and forces future taxpayers to pay for services they may not have benefited from. Deferrals help to ensure that the revenues and expenses reported in each year's financial statements are only that year's revenues and expenses. That's how they help you evaluate whether a government truly made ends meet, a concept that the accounting standards refer to as interperiod equity. Most of the deferrals that governments are required to report can be thought of as revenues and expenses waiting to happen. They will eventually get their turn to be reported in the financial statements as revenues and expenses when the appropriate year arrives. An example of a deferred inflow that performs that function relates to property taxes that are levied before the year they are levied for. Some governments will establish their property tax levy for the following year toward the end of the current fiscal year as part of the process of adopting next year's budget. The accounting standards say that when a government has a legally enforceable claim to property tax payments, it should report an asset, property taxes receivable, and property tax revenue. Establishing the property tax levy often gives governments that legally enforceable claim immediately. But is that what we want to happen if the property tax levy in question is next year's property taxes? Next year's property tax revenues should be reported next year, not this year. So instead of reporting property tax revenues, the government reports a deferred inflow of resources to go with the property taxes receivable until next year begins. At that point, the deferred inflow is eliminated and the government reports its property tax revenues. Now, you might say, if that happens every year, what's the big deal? It's not as if they're reporting 2 years' worth of property tax revenues in 1 year. And you'd be right. But if you're going to determine whether a government has balanced its checkbook, you want to be sure that the government is reporting its property tax revenues in the same year as the expenses they were levied to pay for. Another example of deferrals that help to get revenues in the right year relates to transactions that stretch over multiple years, such as leases or public-private partnerships. Let's say a government enters into a transaction to lease one of its facilities to a business for 10 years, starting next year. As part of the deal, the business pays the government $10 million up front. When should the government report the $10 million as revenue? Right away? In the first year of the agreement? Or over the term of the lease? The accounting standards say over the term of the lease. Why? Well, what is the business buying with that $10 million? It's part of the cost to rent the government's facility for the next 10 years. In other words, the government will be earning the upfront payment as time passes and the business occupies the facility. Therefore, the upfront payment should be reported as revenue as the government earns it. Deferrals help to ensure that governments get their revenue and expense amounts in the right years and in the right amounts. Sometimes the right year is never. Certain deferrals relate to assets and liabilities whose amounts rise and fall from year to year, with the increases offsetting the decreases over time and vice versa. Rather than report revenue in one period and expense in another, or in some cases additional expense in 1 year and reduced expense in the next, a government reports certain deferrals so that only the differences between the increases and decreases are reported as revenues and expenses. This type of deferral helps to avoid overstating or understating revenues and/or expenses in any particular year. One example of this type of deferral relates to a transaction called a hedging derivative instrument. A government might enter into that kind of transaction to protect itself against the risk of losing cash flows or asset values related to another transaction, such as buying an investment or issuing debt. It operates like a mirror image of the asset or liability, its value changing in the opposite direction. Despite the increases and decreases in its value over time, if it functions as intended, it begins with no value and it ends with no value, as you can see in this illustration. Rather than reporting revenue in years when the hedging derivative instrument's value increases and expenses in the years when its value decreases, a government reports deferrals in the amounts of the net increase or decrease. In this example, the government reports a deferred inflow while the value of the hedging derivative instrument is positive, and a deferred outflow while the value is negative. The government's intention is for the hedging derivative instrument to protect it from loss as long as it has the related asset or liability. So increases in the derivative instrument's value during its lifetime are not resources the government can spend, and decreases are not costs that the government will need to pay for, which is the reason why they are not reported as revenues and expenses. Doing so would overstate or understate them and negatively affect your analysis of the government's financial health and your assessments of whether it achieves inter-period equity. CRI provides a range of free resources to help you understand deferrals. In addition to a recording of a detailed presentation, Demystifying Deferrals, there are other short takes videos answering key questions about deferrals, as well as slide decks for all of the recordings, a companion slide deck that dives into the technical requirements of all of the deferrals required by the GASB, including debits and credits, a short plain language article that covers deferrals in a nutshell, a longer plain language article that covers the same ground as the detailed presentation, a third plain language article that explores how municipal bond analysts, taxpayer associations, legislative staff, and other users of financial statements can utilize deferrals information to analyze government finances, to make decisions, and to assess government accountability. And best of all, an ebook that encompasses all of those resources and can be found on CRI's website at criadv.com.